Welcome Accounting 101 students. This tutorial will help you with your adjusting entries in Chapter 3. First, let's go over a few formulas that we have. Of course, assets equal liabilities and owner's equity, revenues minus expenses equal net income, and debits equal credits. These are always going to be rules that we'll be using. What we want to look at now is the accounting period. This accounting period is a calendar year, so it's going to be January 1st through December 31st. Okay, it can be a fiscal year, it can be any 365 days. And the way we're looking at things here in the adjusting process, we have the cash method accounting that we've gone over, where they recognize revenues when the cash is paid, and they recognize expenses when cash goes out. It's a mom and pop store type operation. It's good for simple accounting, simple basics, but it won't work in corporate accounting. We use what's called the accrual basis. An accrual basis means we're starting with this year. I'm using the calendar year, but revenues will be recorded when they're earned, not when cash is received. And expenses will be counted when they're incurred, when you use the expense, not when cash is paid out. So under the accrual method, revenue is recorded when it's earned. That's a GAAP, generally accepted accounting principles, and it's known as a revenue recognition concept. We have the matching concept, where expenses are reported in the same time period as the related revenues. So therefore, we're matching the expenses that belong in the period with the revenues that belong in this period. And the adjusting process, what we're doing, it's like Vegas. What happens in Vegas stays in Vegas. What happens in the accounting period has to be kept in the accounting period. Important to remember, this is the end of the accounting period. The business is no longer open, and cash will not be an adjusting entry. Okay? We'll be adjusting for revenues and expenses to make sure that we have all the revenues that occurred into this period. We'll be accruing them, and any expenses that belong in this period will be accruing them as well. Every adjusting entry will have an income statement entry and a balance sheet entry, and cash will never be one of those entries. So very simply, when we're adjusting for revenues, I have a few that are labeled down the bottom. I'll shrink it down for you. Okay, so we want to go to fees earned first, our revenues. And again, there's no cash entry, but there's only a few entries that will be involved with fees earned. We have a credit here on 12/31 for $1,000. Okay, and here we have the accounts receivable. Okay, this is an accrued revenue. It's happened, but it hasn't been placed in the journal yet. Okay, so we figure out that we've done some work for a client, $1,000 worth of work, and they owe it to us. So this is our debit and credit, and we can see it down here. We're accounts receivable for $1,000 they owe us, and fees earned, we're recognizing that revenue. So we have an income statement entry and a balance sheet entry. Remember, fees earned and revenues and expenses are part of owner's equity. That's why I have them here. Even though they're on the income statement, they're part of owner's equity. So the fees earned, when we have a revenue, there's only three places it can come from. Okay, when we have this credit, the debit's either going to be an accounts receivable, a cash, which we don't have in adjusting entries, or an unearned revenue or a retainer. And that's what the next entry is. On 12/31, we have this $500 we're recognizing as a revenue, and we're taking it off an unearned revenue, which is a liability. Sometimes clients will pay you in advance, sort of like an attorney. When you see an attorney, you might pay them a few $1,000s up front, and they put it on the books, but they haven't earned it yet. So we're looking at it and we said this is what we know as a deferred revenue. Okay, and we have it down here. The revenue we're recognizing for $500, and the unearned revenue we're reducing it by $500. It was paid up in front on 11/1, and we've done nothing with it. We received the cash. We've done nothing with it, but on the last day of the month, or the last day of the year, we realize that we've done some work on it, so we need to adjust that. So we recognize the revenue, and in this case, they've already paid us, so we're going to reduce this liability. When someone pays us up front for doing business, and we haven't used it, it's a liability to us. So this cash was sitting there waiting to be earned. So again, there's only 3 areas when we're dealing with a revenue. One would be cash. There's no cash transactions for an adjusting entry. Business is closed. An accounts receivable, which is an accrued revenue, something that's happened but we haven't entered it into the journal yet, or a deferred revenue, in this case, taking out of unearned revenues. And those are the only 2 revenues we're adjusting for. And now we have to adjust for some expenses. Insurance expense. When we look at prepaid insurance, it's the same way. That's going to be a deferred expense. We have it down here where the insurance expense is recognized for $200. But prepaid insurance, again, that's a deferred expense. It's been on the books already. We purchased the insurance on 11/1 for $1,200. And on 12/31, we realized that $200 of that has been used, okay, for the 2 months, for 11 and 12. So $200 is going to be reduced from our prepaid insurance, and we have our insurance expense. Another expense is depreciation expense. Depreciation expense happens when we buy a fixed asset, whether it be a truck or a building, something that we're going to expense off over time. In particular here we have a truck. We have bought a truck for $20,000 and we put it on the books. It stays on the books as $20,000. That's its historical cost. But we need to write it off over time. In this case, we have a $500 depreciation expense on the truck. So whichever way we've used, and you're going to learn this in further chapters, how to come up with the depreciation. But in this case, we have $500 accumulated depreciation, and we also have a building of $2,000 depreciation. Added together is $2,500 depreciation expense. In your book, sometimes they'll have a depreciation expense for truck, depreciation expense for building, and you'll just do them directly. This is a compound entry. Notice that we don't credit truck for the $5,000. We have this accumulated depreciation truck. Now, this, you'll notice it's boxed. I boxed my contra accounts. This is a contra account. It's an asset account, but the rule tells us that assets increase on the debit side. Well, here is an asset that actually increases on the credit side. It contradicts the rule. So therefore, it's a contra account. Every time we have a contra account, it's going to sum up something. Okay? So we bought this truck for $20,000. We've used it. It's depreciated $500. So now we have what's called a book value. Cost minus its accumulated depreciation equals book value. And in this case, the book value would be $19,500. Anytime we want to sum something up, we have one of these contra type accounts. Same thing with building. We put it on for $50,000. We don't decrease the building cost. We'll have accumulated depreciation, which is a contra depreciation account, which adds on the same side. So it really, the book value is $50,000 minus the $2,000, or the book value here is $48,000. But we're trying to write off this expense over time. And we'll get into depreciation, like I said, actually in Accounting 102. So we have some other wage expenses. Here's the depreciation expense. It's deferred expense. Cash is already transacted. And we have wages expense, accrued expense. Wages sometimes fall in the middle of the week. For example, let's say that the 12/31 falls on a Wednesday, and we have $500 in wages every week. So it would be $100 per day. So if it falls on a Wednesday, we'll have a wage expense for that week of $300. It falls on a Wednesday, so Mondays, Tuesdays, Wednesday wages have to be expensed to keep it within the accounting period. The Thursday, Friday expenses will be in the next accounting period or the next year. So we have this wages expense, and we haven't paid the people yet. We're going to be paying them at the end of the week. So we owe it to them. So we'll have this wages payable, which is a liability. We'll owe it to them. Again, debits and credits. Debits equal credits. Our balance sheet is still in balance. So here's your wages expense and your wages payable. And accrued revenues and expenses have occurred, but have not been recorded, and cash has not been transacted. A deferred revenue or expense have been recorded, but need to be adjusted. Cash has already transacted. And hopefully this tutorial will help you get through your adjusting process. Thank you.